So AI overall, it's probably going to crash the stock market and it's probably going to crash the economy. But there are three companies right now that if you buy them and if you understand everything I say in this video, you're going to realize that these companies are safe. Yes, the overall market might crash, but these three companies, they will do fine either way. Now, we are going to dive into this massive news article that just dropped out today from Amazon. And they're saying, look, we're going to lay off 30,000 corporate employees. Why? Because we don't need them, because AI is becoming so freaking good that we could do more work with the same amount of people. Is Amazon the only company that's probably going to do this? In my opinion, no. We are just getting started. So let's dive into that list of those three companies that are going to win either way. Now, if I slide myself down, you'll see that Amazon, of course, is number one. So we're going to go in order of my least favorite of the three to my most favorite of the three. And I haven't really talked much about these other two companies too much. So you are going to want to stick around because what you're looking at right now in the stock market, I think that you're looking at the wrong thing if you're looking to buy AMD, Nvidia, or TSM. So if we take a look at the chart, you could see that Amazon is up roughly 49% in the last 5 years. But all the other hot stocks, it's like, why are they up way more than Amazon? Amazon's this great behemoth company. They have AI, they have chips, they have robots. Why is Amazon not going up as much as the other companies? And it's simply because it's not the hot stock right now. But guess what? With this massive layoff that just happened, they are set to grow their revenue and grow their earnings per share by a lot. Now, if we head into the charts right here and see what Amazon has going on fundamentally, you're going to understand what I'm saying because there's something that not many people are looking at right now, and it all comes down to their capital expenditures. So let's take a look. So, capital expenditures is basically how much money you're blowing on new things that you're buying. A lot of these companies that are called the hyperscalers, they're spending a lot of money on AI data center build out. So Amazon from 24 to 25, yeah, like they're almost doubling their spending from 77 billion to 113 billion for capex. A crap ton of money. And the companies that are benefiting from this spending on Amazon is going to be the things like AMD, TSM, and Nvidia, of course. But notice how this growth starts to slow down right here. And this is good slowdown in growth because this is spending. They're going to slow down how much they're spending. Now, companies like TSM, Nvidia, and AMD, they're not going to do as well through this time period, in my opinion, because the hyperscalers aren't going to be buying as many chips. But understand this, Amazon, who now has the majority of their data centers built out, they spent all that money right here. Now they're going to start reaping the rewards of this data center build out. So they're going to be spending less money, have less employees that they have to pay for. And keep in mind, these 30,000 employees that they are planning to lay off, these are corporate employees. So they probably make at least three times as much as what the typical average Joe makes at Amazon in a warehouse. And they get stock options probably too. So the stock is going to be less diluted because there's going to be less, options that are going to be exercised on us. And this AI stuff is going to make the company way, way, way more efficient. So when you have more efficiency, more revenue, more earnings per share, the stock price is set to explode. And don't get me wrong, like I think that AMD and Nvidia and TSM, they're still going to do fine in the future, but those are the companies that are laying the foundation for this AI data center build out. But now it's the hyperscalers' turn. It's their turn to reap the rewards from this stuff. And in my opinion, Amazon is a case in point, textbook example of a company that is growing earnings per share. Like, let's take a look at earnings per share. Been very, very well. And 26 and 27 estimates are expected to be very, very good too. And honestly, I do agree with that. So this is a company that is kind of underappreciated right now. And I do think that when things slow down a little bit and when CapEx actually starts to slow down, that is going to immediately hit the bottom line on Amazon and the stock price is probably going to go up. Now, if we look fundamentally on the company, how is Amazon valued fundamentally? Well, let's take a look at what the price earnings ratio level is. We're going to go to a 3-year chart here just to get rid of that big blip. And you can see that Amazon is now trading at roughly 33 times earnings. And just a few years ago is trading at 71 times earnings. So as earnings per share is going up, the stock price is not going up as much as earnings per share. So that's why fundamentally speaking, it's getting cheaper and it's getting safer. And all of this is at a time, again, the capital expenditures are going to slow down. That extra money they were going to spend on CapEx is now going to go to the bottom line as earnings per share. And as you know by following this channel, the number one thing that moves the price of a stock in the long term is what earnings per share does. So earnings per share up because of AI, that is good for the company of Amazon. I am buying Amazon right now. Is it going to be bumpy in the short term? Yes, of course. It's always going to be bumpy in the short term. And overall, I feel like the stock market's super hot right now. So if we do get a lot of up and down volatility, it's fine. Just accept it. That's part of being invested in the stock market. Now, I did talk about how the stock market's going to crash, and we are going to get to that in a second because, again, think about AMD, NVIDIA, TSM. SMCI, Dell, companies like that. Think about the companies that are helping integrate these chips. That is what so much of the stock market is being based on right now. Like if we look at the index triple Q, which is the NASDAQ, you could see that roughly 9.58% of the index is going to be NVIDIA. So if 9.58% is NVIDIA and NVIDIA is probably going to slow down their growth, that sure doesn't look good for NVIDIA. Also, look at Broadcom. Broadcom is huge on AI data center build out. If Broadcom slows down, if NVIDIA slows down, it doesn't look good for the indexes, but the companies that are integrating these chips and they're going to capitalize on it and spend less on the chips because they already have all the chips that they need, they're going to do very, very well. All right, so we went through Amazon. We have two companies left. I feel like all three of these companies are honestly like recession proof, they're AI proof. They spend a lot of money on CapEx, but they're about to slow down a lot of money on CapEx and they are set to capitalize. Okay, now number two, and I'm not saying that Amazon is better than Google, they're kind of tied in my book, but number three is the big one that is honestly going to win the most, in my opinion. It's cheap, the growth is good, they're going to slow down CapEx, and that is going to get realized in the bottom line as profit. And when that happens, mark my words, the stock price is going to absolutely explode. So if we were doing this in order, I would say that Google's my least favorite, Amazon's in the middle, and then the third one, which we'll get to in a second, it's hands down my favorite. So if we flip over to Google and take a look at the chart, you can see that the stock, geez, it's been on an absolute tear lately. If we take a look at the 5-year, you could see it's up roughly 207% in 5 years. Now, many people are going to say, well, Brandon, is that move sustainable? Is the valuation too hot? Let's take a look. Let's see where we're at. So we're looking at the price earnings ratio level, 5-year chart. And if you ask me, like Google was at 16 times earnings on that Liberation Day tariff dip. That was a pretty fair price for Google, in my opinion. Now we're trading up here at 26 times earnings, which is a little bit more expensive. But again, expensive relative to what? We have to see how much they're actually growing. So we go to estimates, we flip over to here and go to annually, we go to revenue. You can see that revenue expectations are absolutely exploding on Google. You know, earnings per share growth is projected to be pretty darn good. From 24 to 25 is a pretty good jump, but from 25 to 26, it's kind of like, man, it's good, but it's not amazing. But then from 26 to 27, it is expected to ramp up a little bit. This is roughly like a 15 to 20% earnings per share jump. But now if we go over to CapEx, take a look at this trend again. From 24 to 25, there's a lot of capital expenditure money that they're blowing right here, and that's why AMD, NVIDIA, and TSM are doing so good right now. But eventually it's slowing down. Like it's going from 50 to 80. Like it's not a double, but it's almost a double. We're not going from like 80 to 160 and 160 to 320. Like the growth is slowing down a lot, and it's very, very clear that these companies are blowing a ton of money on capital expenditures, data center build out stuff. But once it gets put in place, they're going to capitalize. They're going to be able to do more work with less people. And Google, I wouldn't be surprised if they start to lay some people off too, just like Amazon is doing. Because think about what it all boils down to. All of these CEOs, they want the same exact things: more revenue, more earnings per share. How do they do that? They got to become more efficient. They got to push better products, whatever it may be. But the way that's going to, mostly make them more efficient is going to be because of AI. More work with less people. And maybe, someone gets laid off, maybe some people retire, maybe some people just simply get fired. They're going to let those people go, but they're just not going to backfill those positions. Now, if we flip to this chart, this is honestly a chart that Jerome Powell is probably sweating bullets at overnight, and he's probably not sleeping good, to be honest with you. But this shows you the number of unemployed people per job opening. So let's just break this down and understand what this really means. Down here, okay, there's 0.5. So what this means is there is 2 job postings for every 1 person looking for a job. So think about it. You are 1 person out there looking for a job, but you have McDonald's and Starbucks hiring. You have options, so it's easy for you to find a job. But if we go to the right to current times, we're now at 1.0. So now there's 1 person looking for a job, but there's only 1 job posted. So you can see that that labor market is now pretty much within balance. But what happens when Amazon lays off a bunch of people, and then maybe Google lays off a bunch of people, and then Tesla lays off people, and Apple lays off people, and it just starts to compound and compound and compound. Things could go south, and they could go south really quick because, again, there's not a lot of new jobs being posted, and when these people get laid off, it's going to be very hard for them to find a job, in my opinion. And as time goes on, it's like AI and robotics are going to become so good, it's like, I don't even want to have human employees anymore. And I was just reading this article earlier today where it's like, in the next 5 to 10 years, it's possible that AI could replace 1/3, 33% of the entire US economy. Think about that. Where are those people going to work? Where are they going to find a job? How are they going to pay their bills? It could honestly get pretty bad out there. And that's why the title of this video talks about how AI could potentially crash the entire stock market. And it's simply going to be because AI is so good and so powerful that we just don't need as much human labor anymore. Like, think about it and drop your comments below. I'm really curious what you guys think. Like, AI is becoming so darn good that we are starting to see the layoffs already, and we are just like 2 or 3 years into this major AI data center build out. Imagine how we're going to look in 5 years. Imagine how we're going to look in 10 years. You better figure your finances out right now. You better figure out your job right now, because if you're not saving, if you're not investing, if you are not capitalizing on these companies that are making a crap ton of money right now, remember, we'll get to my number one company in just a second. If you're not capitalizing on these companies right now, you have no hedge in place. You have to hedge yourself to be able to win when the market's going up and win when these companies make money. Because if you lose your job, at least you're going to be sitting on a couple $1,000,000. All right, so let's go back to the chart. We'll see what we got going on here, and we will get to the final company. So we went through Amazon. We saw they laid off a bunch of people. We went through Google. Both of these companies, they spent a lot of money on CapEx. That was kind of dragging their earnings per share down. But once the CapEx slows down, all that capital expenditure money is going to go to the bottom line as earnings per share. So then profits will go up and the share price will probably follow. And again, these companies are trading at fair value, in my opinion. So the stock price is probably going to keep going up, even though like Google, geez, let me measure this really quick. I realized Google just made a humongous move off of the April low, up, geez, 82%. Like, it's likely to keep going up. Maybe it's not going to be straight up at the same pace, but in the long run, this will probably be up and to the right, just like Amazon. Okay. Now let me scroll down and show you company number 3, and that's going to be Meta. Now, before you click off, I have to show you something that I've never shown you guys before, because it's really going to make it click why Meta could be one of the biggest companies in the future. Nobody's really even talking about this. So let's just take a look at the 5-year chart. You can see the company is up roughly 170% in the last 5 years. Now, if we flip over to the data, let's take a look at what we got going on. We got Meta, we got some CapEx. We're on the annual rate here. Let me get myself out of the way, and we will see what we got going on here. So 2024, $37 billion for CapEx. 25, 70, so roughly a double. But then is this going from 70 to 140 for 2026? No. Is this going from 98 to roughly 200 for 2027? No. Again, building on that thesis of companies like NVIDIA and AMD and TSM, they are amazing companies and they're probably going to do very, very well going into the future. But the growth is not going to stay where it's at, because the major AI data center buildouts is happening right now, but it's not going to be like that forever. You do not have to pour the concrete foundation every single time. You do not have to wire all these chips every single time. Once they're there, it's good. Maybe you want to get a new chip. That's fine. Unplug it and plug it back in. I know it's more complicated than that, but you're just not starting from square one every single time. So in my opinion, Meta, geez, like, this stock is going to absolutely explode in 2026 and 2027 because this CapEx is going down by so much. Now, here's the key thing that we have to talk about, and let me slide myself down just a little bit so you can see what I'm clicking here. Revenue. What is Meta's revenue going forward? Okay. 2026 revenue is expected to be $229 billion. Got it. $229 billion. But if we go to CapEx, you can see that it's roughly $100 billion. The CapEx is almost half of what they are bringing in as top line revenue. But that eventually is going to slow down, because you could see that 2027, it's $105 billion for CapEx, but then if we look at revenue for there, it's not even close to half. So there's going to be that disconnect of spending less percent of the revenue on capital expenditures. So again, that is a very, very big tailwind for the stock. And if we just look at earnings per share growth, you could see that, from 24 to 25, good growth. 25 to 26, kind of flattish. But then from 26 to 27, we are expected to absolutely explode. And honestly, I feel like these figures are a little bit on the bearish side. I do think it's going to be a lot more than what it's actually being projected, because they just spend so much money on capital expenditures for data center build out. Once they get that stuff built out, that money is going to go to the bottom line as earnings per share. And if we just take a look at my Schwab account, like, yes, I'm making a crap ton of money. Everybody's a genius in this bull market. I'm up 66% in the last 6 months, up roughly $500,000. Yes, could I have made more money in the last 6 months? Yeah. Like, maybe you made 200%, 300%, 400%, whatever. You bought calls in Palantir and SoFi. You're a genius because everything went up. But at the end of the day, it's like this. The market is not always going to be this easy. Valuations genuinely are stretched right now. If you are not prepared for a 40% stock market crash, you are going to get obliterated. You're basically just going to be this one-trick pony that only survives in the bull markets. You get wiped out in the bear markets, and you're just never going to capture that compounding year after year after year, because maybe you go from $100K to $1 million account, but when the next big bear market comes, you go from $1 million down to zero, and then you just restart the process time and time and time again. So I'm here for the long run and I do this stuff conservatively and I sleep very, very well at night. And honestly, like 99% of the setups that I look at, they're usually all a no because there's simply just not that many good opportunities out there, especially when we have all these AI layoffs that are probably in the pipeline coming. Jerome Powell is cutting interest rates because he's scared about the labor market and he's trying to stimulate things a little bit. Amazon, Google, Meta, they're probably all going to do good in the future. Google, yes, I'm a little bit worried about their moat and maybe it's not going to be good forever. We'll see what happens. But I'm talking about the next 5 years for these three companies. I think they're going to do very, very, very well. So that's what I got for you guys today. If you got value in this video, definitely like and subscribe. Course and Discord's below. It's 100% free for the first couple days. You could cancel before you even get charged. Check it out. See you guys in the next one.